The Buffett Indicator, also known as the market cap to GDP ratio, is a financial metric named after the legendary investor Warren Buffett. It serves as a valuation tool to assess the overall stock market's health and whether it is overvalued or undervalued relative to the size of the economy. This indicator gained popularity due to its simplicity and its association with Buffett's investment philosophy. The Buffett Indicator is calculated by dividing the total market capitalization of all publicly traded stocks in a country by the country's gross domestic product, GDP. The resulting ratio offers insight into whether the stock market is potentially overextended or undervalued compared to the broader economic activity. When the Buffett Indicator is relatively high, it suggests that the stock market's total value is high in relation to the economic output of the country. This might indicate that the market is overvalued, potentially leading to a market correction or a bear market. On the other hand, when the indicator is low, it could indicate that the market is undervalued, possibly presenting buying opportunities for long-term investors. The underlying idea behind the Buffett Indicator is that the stock market's value should not be too disconnected from the real economy. If the market's value becomes significantly higher than the economy's ability to generate profits and economic activity, it could be a sign of a speculative bubble. However, it's important to note that while the Buffett Indicator can provide valuable insights, it is not a foolproof predictive tool. There are limitations to this approach. For instance, the indicator doesn't account for interest rates, inflation, changes in market dynamics, or shifts in investor sentiment, all of which can influence stock market valuations. Moreover, comparing the Buffett Indicator across different countries might not be entirely accurate due to variations in economic structures and market conditions. A country with a larger share of multinational corporations might have a higher market capitalization relative to its GDP without necessarily signaling an overvalued market. Investors and analysts often use the Buffett Indicator as part of their broader toolkit to assess market conditions and potential investment opportunities. It serves as a reminder of the importance of understanding the relationship between market valuations and economic fundamentals. While it can provide valuable insights, it's wise to consider multiple factors and indicators before making investment decisions. In conclusion, the Buffett Indicator is a straightforward yet insightful metric used to evaluate the relative valuation of the stock market compared to a country's GDP. It reflects Warren Buffett's principle of investing with a long-term perspective and a focus on fundamental value. However, like any single metric, it should be used in conjunction with other analyses to form a comprehensive view of market conditions.